Welcome to the second of my educational videos. I apologize if these videos are not very exciting, but as the topic is related to personal finance, I feel very strongly that you as an investor should have the required information so that you make good decisions. The first topic we will cover is the structure of mutual funds. This is to show you that there are various entities and processes that work to protect your money. The sponsor is the entity that is the parent organization of the mutual fund. The sponsor appoints a trust and an asset management company. The money invested by you is placed in the trust, whereas the asset management company is appointed to manage this money. Both organizations have oversight from either trustees or directors who are accountable to SEBI, which is the regulator for the financial services industry. Securities are held by the custodian and money is held with banks. Investor transactions are processed by the registrar. Audits are regularly performed by the AMCs themselves and by SEBI. We now come to the benefits of mutual funds. The first benefit is professional management. Investors that do not have the ability to track individual stocks regularly and cannot make decisions on buying and selling based on balance sheets and other financial data should look at investing in mutual funds and leave the decisions to professionals. Portfolio diversification. With 5,000 rupees, one can invest in a few good stocks. An issue with one stock would have significant impact to your portfolio. However, an investment of the same amount in an equity mutual fund would have lower impact as the allocation to the particular stock would be lower as the mutual fund would be able to purchase a higher number of stocks. Point number 3, lower costs. Investing in mutual funds reduces costs as they are shared by multiple investors. The size of the investments also leads to economies of scale. Point number 4, transparency. Mutual funds are very transparent and all information related to holdings, financials, etc. is mandatorily published on the website of the AMCs and in newspapers. Point number 5, compounding of gains. Investing for the long run also allows for compounding of gains, leading to better returns. Point number 6, liquidity. The fund transfers the money to investors within a few days upon a sale. If the investment was directly in stocks or bonds, the investor may have a more difficult time. Point number 7, taxes. Mutual funds incur capital gains taxes only upon sale by the investor, even though the mutual fund is selling and buying securities on a regular basis. If the same thing was done through stocks, capital gains would be payable upon each sale. Point number 8, oversight. In my opinion, mutual funds are the safest investment vehicles as they are heavily regulated by SEBI, which has laid down regulations and best practices to help investors. We now come to limitations of mutual funds. There are only a few limitations. Let's go through them. The first one is portfolio construct. Investors have no say in the investments made, and they are normally passive participants in the journey. Point number 2, guaranteed returns. In products like fixed deposits, one is assured of returns. However, in mutual funds, accurate prediction of returns is not possible. Point number 3, costs. Though mutual funds have a reasonable total expense ratio, one has no say in the associated costs. I hope this video was helpful, and do feel free to reach out at the email address or mobile number provided. Do visit my website, which is www.aditshah.in. Links to my social media pages are available there. Do follow me in case you found this video to be beneficial. Thanks for taking the time to view this video. Your feedback is appreciated.